What's a simple thing that you can implement into your trading that will have an immediate impact on your results? One simple entry technique that can instantly explode your win rate. That's a very, very simple thing. We're not talking about any complicated analysis. No, nothing like that. This is very simply waiting for the candle close. Now, I talk about this all the time. And in this video, we're going to review always waiting for this before entering trades from GIAFX. We're going to discuss this technique. It is my goal in this video to convince you that waiting for the candle close is one of the simplest and most effective things you can do to explode your results and explode your win rate. Now, your results are up to you, but I'm going to show you some reasons why this is something you should implement, I think, or any trader should at least consider very seriously, because by not waiting for the candle close, there's some very serious consequences. So let's get into it.
Video if you want to stop losing trades pointlessly. I'm going to teach you about closures, why they're important, and how you can actually use them to validate trades, avoid losses, and make big wins. So let's not waste any time. We'll get straight into it now. So first things first, what is a closure? Well, if we're looking at a 1 hour chart here, let's imagine these candles are hourly candles. That means every hour that passes, a candle will form. And at the end of the hour and the start of the new hour, the candle will close. So for example, this would be our closure. This would take place at the start of a new hour. This would be the open price of the next candle.
Simple, 1 hour chart, every candle's 1 hour. That means you get one close at the end of every hour. Simple, straightforward, easy, right? Now, let's keep going.
At the end of that hour, once again, we get a closure, and this continues. We get a closure and open at the start of each hour.
Yep.
So a candle closure is just where the candle is when the new candle opens.
That's right. And if it's bullish, it's going to close. It's going to be up here, right? And then if it's bearish, it's going to be down here, right? That's what defines whether it's a bullish or bearish close. A bullish or bearish close.
The closure is here. The closure is then there, 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 there.
Okay, so for any new trader, this is what defines the color of the candle. The color of the candle changes as soon as the candle closes, okay? So if it closes up here, then that's gonna be bullish. If it closes down here, then that's gonna be bearish. And as soon as that close happens, then the candle color is confirmed.
And all the way up there, okay? Now, the reason we need to wait for these closures is because until a candle closes, it can reverse on itself. Now, if we take a look at...
Okay, so this is the first reason why you've got to consider waiting for a candle close, because it can reverse on itself. And if you haven't been trading or you haven't placed any trades, then you have no idea about this. But when you start trading, you see this very quickly, that the appearance of a candle can look one way for the entire candle, and then right before the close, a few seconds into the close, can completely flip on you.
In this instance, we're in an uptrend in this example. The market's uptrending, we formed a high. The market then came down, formed a higher low. Now the market's pushing up to form this potential higher high.
Okay.
If the market was able
so the prior high was here. Now we're forming a higher high here.
to close over this swing high, that would open doors to continued uptrending movements, meaning we could continue buying this market because we know it's going up, because it's continuing to make new higher highs. But if the market does not close above, and instead the market does this and pulls back down before that hourly candle closes, if it closed down here, then this would actually be a rejection of the high.
Why is that? Because this tail on the top of the candle, or wick it's also called, right, actually shows selling. If you look at a shorter time frame, this is a 1 hour chart, but if we were to look at a shorter time frame, like a 5 minute, we would see bear closes here because this now becomes a resistance area.
Because when we're looking at candles, we have the bottom.
So let's just look at that, okay? We've got two different scenarios. We've got one scenario where the candle closes on its high above a prior high. And he's saying that's a bullish indication. And it is a bullish indication, okay? Because it's showing buying into the close. So what you want to do as we continue this video, what you want to start to think about is, what are buyers and sellers thinking as we come into the close of a candle? Now, if the chart is a scoreboard and there's bears and bulls and each candle close is a point on the scoreboard, that's a really good way to think about this.
Continuing to make new higher highs. But if the market does not close above, and instead the market does this and pulls back down before that hourly candle closes, if it closed down here, then this would actually be a rejection of the high.
Okay, so that's more of a bearish sign. So now look at this. The candle color is the same. Candle color is the same color. This is a bullish. So on most people's chart, this would be a green candle. Okay, this is a bullish candle. He's got the colors changed because I don't know, whatever. He's different. He's different. Okay, but if you have the same pattern with the same candles, however, the close is different. The only thing we changed in these two scenarios, look, same setup, everything looks exactly the same. But we're saying if the candle closes up here, then this is a bullish indicator. But think about what buyers and sellers are thinking. That means that there was buying into the close of this candle. Okay, it closed almost completely on its high, which means buyers are confident if they continue to buy through this hour. Remember, it's an hourly chart. So they're buying through that hour and they're still buying a few minutes towards the end of that hour, right? That shows high bullish conviction. However, if we take everything the same, all else equal, and we just change one factor, the candle close, this is actually a bearish indication. So this is the first reason and the first lesson here that we want to really start to think about, oh, okay, the candle close is actually incredibly important information. And it may be the most important data point on this whole chart. Notice it's even more important than all of this down here. And this could change again in the last few seconds of the candle close. So you could think it's one way, and then in literally, if it's a 5-minute chart, it could be the last 30 seconds. And the whole thing could flip.
On top or below candles. Wicks show attempted prices within a given time frame. So in this instance, this wick shows us that the market attempted to go this high, but it actually got rejected and the closure ended up being here.
Showing a resistance zone up here, right? Because it tried to move up and there was resistance.
Now this means that the only confirmed price action within this price range is between this low, the open price, and this high, the closure price. Anything above that was just attempted price, also known as rejected price. So this is rejected price action, and then this is confirmed price action, just here. Now, what does this show? Well, this shows the confirmation has actually confirmed lower than the previous swing high, and the only push above that we had was a wick, which was rejected. So this market attempted to push higher but failed to close above, which actually rejects entirely the concept of seeing closures and continuations above this level, and instead suggests that maybe we could move even lower because we
So it could literally be the opposite.
haven't closed above the high, so we've rejected a new high, maybe indicating that we could be ready to turn into a downtrend. Now, if you saw this candle while it was open and it's moving up and down, and you decide to buy this candle before it closes because you think that it's closing above the swing high, well, if the candle then pushes all the way back down here.
Okay, see what he just did there? That's actually what it looks like when you're trading. And again, if you're not trading and you really haven't experienced the live markets, I don't mean watching videos on YouTube, I mean actually trading, okay? That's more like what actually happens when you're in a trade, okay? You think that this baby is going up and the candle goes from here,
Think
okay,
that it's closing above the swing high. Well, if the candle then pushes all the way back
to there in like 10 seconds, and you're like, oh, baby, and you actually bought all the way up here, and now you're sweating.
down here, you've bought on unconfirmed price action. You've actually bought into a rejection of higher prices.
Okay, so simple answer why you should wait for candle closes before your entry, because it's confirmation. A candle closes confirmation. You have an idea as you're looking at the chart and as that candle's going up and down, but only until the candle closes is what you're looking at confirmed. If the candle hasn't closed yet, it's not confirmed. So just think about this with simple logic. Isn't it better to wait for confirmation of what you think is going to happen Isn't it better to wait for confirmation? Or is it better to not wait? I'm arguing to you, and I want to convince you that it is always better to wait for confirmation. And it doesn't necessarily have to be on the time frame you're looking at. It could be a shorter time frame. We'll talk about that in just a minute.
Which means the likelihood of your trade working out and not instead doing this is now considerably lower. And it's likely.
So it lowers the probability is what he's saying, because every candle close shifts the probability. So if the candle closed up here, then the probability for a bullish move is higher. But if the candle closes down here, then the probability for the bull significantly drops.
This trade could reverse on you. So if you bought up here during this push up, you had your stop loss here, well then it's very possible the market could even sink and stop you out of your
Easily. That could easily happen.
trade without actually playing off at all. If you wait for the next hourly candle to open, so you wait for a closure and the next hourly candle opens like this, for example, well, now you have that confirmation. So the likelihood of us continuing even higher is actually now pretty much set in stone and a lot more likely.
It's not set in stone. Nothing in trading is set in stone. So pretty much, yeah. Let's emphasize the pretty much.
Because the market has proven to us that it's ready to make new highs. So that's why we need to wait for closures. Because if we don't get a closure and instead we get a wick, well, then it's likely that the market will flip on us.
Okay, so here's a couple more rules for looking at candle closes. We talked about waiting for the candle close and we've established some reasons as to why. Yes? Yes. Okay, now here's a couple more things to consider. One, did the candle, and he's hinting at it right here, did the candle close on its high or did it not close on its high? Thing one. Thing two, did it close above its midpoint or did it close below its midpoint? Now, if it closed as a bare minimum, if it closed at least above the midpoint of the candle, then we can say that that's a bare minimum confirmation of what we're wanting to see if it's a bullish candle. Okay, now this example here, it didn't even close above the midpoint. So if the candle can't even close above the midpoint, then that's a very weak signal. So bare minimum, did it close above the midpoint, ideally on its high, or did it close below the midpoint? And then if it closed below the midpoint, then we have to start to consider that this bullish close is actually more bearish than bullish.
Or at least the probability of the market flipping on us is a lot stronger than it would have previously been.
Yeah.
Which means you can get caught up buying against movements like this that could
and get absolutely wrecked. And you don't want that to happen. So this is very important.
Instead actually lead us into a new downtrend. So following on from that, if the swing high was rejected, telling us not to get into a buy trade, and then the market moved lower and pushed past the previous swing low, well, this could potentially open the doors to trading the other way, which could completely flip our bias. And if we were aware of this and we waited for confirmations, we'd be able to take advantage of this new bearish price action. But what could also happen is actually we go and reject the low as well. So taking a look down here,
which is likely. Now, why would a rejection down here or a reversal is what we're talking about? Why would that be important? Or why would that be possible, right? Why is he saying that that's a reasonable expectation, which is basically what he's saying? Because look at this. We went all the way up and then we went all the way down almost, okay? Almost all the way to that low. So this is technically a higher low because this is probably a couple points, a few ticks above here, but that's how strong the bulls were. The bulls were not very strong. The bulls allowed the bears to get all the way down here, showing very, very bearish, okay? So this chart is strongly bullish and then it's strongly bearish, and the bulls only kept the price above this prior low by like a tiny margin, okay? So this actually looks more like a trading range. Now, what happens in a trading range is traders buy at the bottom, which is support, and they sell at the top. He's calling that rejection. So if you see this very strong bear bar closing on its low here, the possibility of there being buyers down here, support, this is actually a possible support area. And I would say it's a likely support area. But we have to, again, the theme of this video is looking at the candle close and taking that into consideration when we are thinking about what's going to happen.
Say we pushed down initially, we formulated some bearish price action, but then before the candle closed, we had a push back up like this, and then we closed as a bullish candle once again.
Okay, so now that actually looks more bullish, doesn't it? Okay, and what he showed there, how he's simulating this, I really like this because that's usually how it happens. It happens like that. It's like swinging all over the place when you're actually trading.
Well, now we are seeing the same thing again. We're seeing a rejection of this swing low. This is basically showing an area where sellers were pushing the market down, but at some point down here, buyers took massive control of this market and ended up running it back up to close at this point.
Which is what we mean when we say support, right? Look down at the floor. Notice the support's holding you up, okay? Same idea right here on the chart. Support, holding the price up.
If, following on from this point, we then had a bullish candle that managed to go up and close above that previous swing high, so we'd be looking around this point here, well, this would then validate the buys. finally, okay? Because what we've actually shown is an attempt to go higher that failed, then we had an attempt to go lower, which massively failed, followed by an attempt to go higher, which succeeded with this closure. And if this candle was to close up here, then we could continue with our bullish ideas, potentially looking to buy on pullbacks to take this market higher. So really, we have to wait for closures because you've seen just how dynamic this market has been. And in this example I've just showed you, how you could have been tricked twice if you hadn't waited for candles to close. First, at this top point up here when the market rejected the high, and second, when the market rejected this low.
You don't want to get tricked. That's another reason, right? This is a very, very simple reason why you should wait for candle closes to enter, because you don't want to get tricked.
Now, obviously, this can be a big back and forth, which can be hard to get your head around. But really, it can all be solved by just waiting for the candle closures like this that we see here. Because if we wait for a closure above or below a swing point, then we have the confirmation we need to understand whether a market is building strength in one way or the other in a meaningful manner.
Okay, now I want to show you an actual real example of this, okay? So let's go to my charts. I use TradingView, and if you want to use the tools I use, go to the link in the description. I've got a link to TradingView. I think this is the best platform. I've been using it for years. So let's say you're trading this, right? I'll give you an example here, and we'll break it down similarly. This looks bullish, doesn't it? Why? Because all the closes are above the moving average. All of them, okay? Now, as soon as we came down here, there were buyers at the moving average. We can see that because there's wicks on the tails. He was just talking about this, right? Price came down and then rejected up, and the bulls were actually able to keep the price above that blue line, which is the average price. So that looks good, and it looks like the momentum from the bears is kind of waning, right? But watch what happens next, okay? Now, next, we get a candle that immediately sells off, right? Immediately sells off. Right? So now, if we're saying that what defines, better said, if we're saying what indicates a bull trend is that most of the closes are above the average price, or either the VWAP or the EMA, whatever you use. If most of the closes are above that, then we're going to consider that bullish. If most of the closes are below it, then we're going to consider that bearish. Then what just happened right here is we have our first possible bearish sign. So although this looked very bullish, now we actually have a bear bar closing on its low and closing below the moving average. So now this is actually starting to look more bearish. But watch what happens next. Next, we move forward and we start to see that, oh, there's actually a tail on the bottom of the candle. Oh, okay. So is it rejecting again? I don't know. Let's go to the next chart. Let's go to the next candle and see what happens. Oh, it looks like it's moving down. I'm like panicking because I think it looks bearish. So I'd be like, hey, maybe you're tempted to actually sell here. But look, it actually closed above the moving average. So we thought that that was closing below the moving average, but it didn't close below the moving average, okay? It actually closed right above the moving average, okay? So we're waiting here and we're being patient for that candle close before we decide what to do. Because remember I said, you don't want to get tricked. So again, we have a close below the moving average, and then we move forward on the chart and we can see that, if we're patient, the data might change. And that's really the point here. You are in a dynamic environment. And so what you need to do is be willing to wait for signs of confirmation. So I'm going to move this forward so that we can really see what happens if we actually wait, because it was starting to look bearish, but then now it's just kind of hanging out here. So it actually still looks bullish. It actually looks like the bulls bought here because there's rejection, bulls bought here because there's rejection, bulls bought here because there was rejection. Even though the bears closed this bearish, technically it's black, that would be a bear bar on my chart, it still doesn't look strongly bearish because the bears are not getting any kind of push down with any strength. If we got one of these down here, then it would look bearish, but it doesn't. So let's continue to move this forward and watch. It's just kind of bouncing back and forth, but now we actually have 2 consecutive closes below the moving average. So that's definitely bearish. And then we start to see this and we're like, oh my God, it looks like it looks like the market's plunging down. So let's say that you bought, I don't know, here after this really strong bull bar up, and then you were expecting to take profits here, and this whole thing reversed on you. Now you got this. You're panicking, maybe, because you see, oh, the market's plunging down. And then look, it starts to plunge down again, but then it closes up here. And then we think, oh, you know what? Maybe it's actually bullish. And then it plunges down again and you go, no, actually it's bearish. And so you panic out and you sell. And then it does this and it actually closes. Look what just happened. We plunged all the way down and then it closed up. Now it's plunging down again. Oh my God. And it actually closes up. Oh, so if you're not careful, you'll just get completely smacked around by the markets. And then suddenly we get this, okay? So notice what just happened. We avoided getting tricked because we waited for those candle closes. And if this happens, right, this is called a trap. You don't want to get trapped, okay? And you don't want to fall into something like this, thinking that the market's going down. And the point here is just to show that by waiting for confirmation, you can greatly increase your win rate and greatly increase your mental peace. And that's what you need if you're going to trade well. You need to be able to be calm under pressure. So waiting for that candle close will help you avoid selling when the market looks like that. And you could see those candles, guys, right? It really looked like the price was just racing down repeatedly, but it didn't.
So whichever time frame you're looking at, whether it's the 1 hour or the 4 hour or the 1 day or the 1 minute, it really doesn't matter. You just need to always wait for those candle closures to occur. When you get a closure like
I couldn't agree more.
This above or below a swing point, you are ready to go with your trades. But if you get rejections like this one and this one here, then you should just wait out of the market until the market tells you to make a move. Let's take a look at an example of this then. This is a market that we've started to see pushing up in some bullish price action. Okay, we're getting some higher
Shout out to my man Captain Crunch in the chat. Patience always wins. You get it, my man.
highs and higher lows forming from an internal structure perspective. Now, if we zoom out, we can see that overall, this is a downtrending market, right? So the larger picture is bearish, and then this smaller picture is bullish, where we're currently getting these higher highs and higher lows. Now we can see what we've got here is pretty much a little swing high. So what we could expect to see would be if the market was able to close above this high, that could potentially lead us into some new uptrending moves, right? So from supply and demand perspective, let's say we wanted to look at possibly buying from this area if the market is able to close above the high that it is currently trading at.
Okay, so here was a prior high and we closed slightly above that prior high.
So if we were to close where we are, we may anticipate that the market could pull back towards demand and then continue buying. This could be the indication that maybe the market is starting to shift, because we'll have seen that this high here is actually now being broken. So that point just there could be seeing a change in the trend, right? We could be starting to see these buyers take control. Now, this is then the point where we want to make sure we are getting closures above this level, right? Above this swing high. If the market is able to close above, that will give us what we need in terms of confirmation to continue trading higher. But if the market fails to close above, then we could instead be potentially about to see continuations lower in this market, because it will show us that the swing high has been rejected. So a rejection would be no closure, and then a confirmation would be closure above. This would leave us with two scenarios. Well, the first scenario would be if we get the rejection, we would start instead looking for a sell. So rejection would potentially open doors to sells. If the market is able to close and give us the confirmation, that would give us what we need in order to focus on a buy, right? So confirmation above, meaning if we just ended the hour exactly where we are now, that would be confirmation for us to buy this market. If we reject and we close beneath, well, then that would be a rejection. That's not a confirmation. That's not a closure. The closure's failed. And we've actually just seen rejected price action up there, which means instead we could look for a sell. Okay, so let's take a look at how this plays out then. If we allow this candle to close and the next one to open, we see that we've actually closed with a rejection here, right? So we got that rejection scenario that we're talking about. This is the point where the candle closed and a new one opened. The next candle has been slightly bullish so far with some rejections, but nothing is really locked in just yet. We need to see how this market is going to move. Now here we've seen a little push down in the market, so we're starting to see a kind of rejection that we might want to see. And now we've seen a little push under the previous structural low. Now that we've started to see this market closing a little bit lower, we could potentially be opening the doors here to take those shorts that we wanted to see. Now, obviously, we're looking to see if there's going to be significant rejection again, because remember, if we saw significant rejections, we could actually just see the market go and close back above this high and continue, which is why we always want to make sure we're looking at closures. Now,
so just one point here. Here you can see, right, he's pointing out that we went above that prior high, got rejected, and what we were looking for was consecutive closes. He's saying closures above the high, but I would say consecutive closes. We rejected here. The bulls got rejected, and then this candle closed bearish, right? And now we've stayed below this prior high, right? This swing high, we've stayed below it, okay? And now we're just ranging. We're going up and we're going down. And we have a double top actually, right? We have a top here and we have a top here, okay? So we have actually a bunch of tops here, a little micro top, micro double top, okay? So now we have 2 consecutive candle closes. However, we also have a double bottom, okay? So when you see double tops and double bottoms, that's just a range. And when the price is ranging, meaning just going sideways, it's kind of like we gotta wait and see, because it's not really strongly bullish or bearish. And until we get a strong indicator that the market's gonna move down, we have to always default to who is in control last. And since this is a bull channel and we've got higher lows and higher highs, then this is going to remain bullish until we get a strong indicator that the bears have taken control.
Because this area failed to close, we can pretty much eliminate that demand zone. And instead, realistically, targets wise, we would be looking at taking this market back down towards some previous swing lows, right? We've seen a failure to trade higher, which means therefore we could potentially see opportunity to trade lower.
And now we have 3 consecutive bear bars. So this is a possible short, okay? However, as I'm pointing out, we have a lot of buying down here. So I would want to wait here for a stronger bearish indicator before entering. Although it is a possible entry, it's just not a very good one as far as I'm concerned.
Okay. So watching this market, we've seen some closures beneath. Just here, we saw a closure under this level initially.
And this is what you see in a trading range, right? This is a trading range. This is a little trading range right here. And so what happens is the price will usually go a few points below it, and then there'll be buyers down here. It's called a support zone. We already talked about that. And then there was strong buying, right? But then look what happened when we got to push up. Then there's strong selling, okay? And that's a trading range. Back and forth, back and forth, back and forth. Two-sided trading.
Initially, we've then seen the market push down. We'd now be looking to see if we can, again, close beneath that level. And as we have here, we would now be looking at opportunities to sell this market if we were able to pull back. So for example,
okay, and then this is actually what I was saying I would want to wait for, which is a strong bearish indication. This is a strong bear bar closing on its low, which is good for the bears.
The setup we could look at would be something like this. We could sell there, we could have stops above the zone, and targets wise, we could trade this down into one of those areas of supply, right? So allowing this.
Okay, and then where he's entering is actually all the way up here, which is an interesting place to put your entry. And if you, so the upside is if you put your limit order here, then you actually get a really good entry price. But the downside is the price might not actually come back to this level. So you might actually miss the trade if that's where you put your entry. So there's pros and cons with every decision. And those are the pros and cons of deciding to enter here.
This market to play out. You see there, we got the pullback, tap into supply. Now the market.
Yeah, see, this is what I'm saying. Like we didn't actually come up here, right? We actually didn't come up here. If you waited for this bear candle close, then the price just went straight down from that point.
It's pushing down.
So the only way to get into this trade would have been to sell down here, sell below that candle, but then you're selling really low. So that's not necessarily a good entry either. However, as I'm saying, pros and cons every step of the way.
Tackling those swing lows. So that's a good thing. That's what we want to see. Now we've seen as well, there has been a closure under this first level. And now that we've approached this second level, what do we get? We got a closure. So let's just zoom in on that real quick. You can see.
Same thing we were looking for up here, right? We were looking for closes above the prior high. Now we're here at that prior low and we're looking for closes below it. We didn't get the closes above the prior high here, but he's pointing out, look, we actually do have one below the prior low. And I'm arguing in this in this strategy, and in all price action, I think you want more than one. So I will always be looking for consecutive candle closes, because remember the example I showed you, right? Remember the example I showed you. Let's just go back to that really quickly. Look, here was a candle close below, okay, a support area. In this case, instead of a prior low, we've got the exponential moving average as our support area, okay? And look, we got a close below it, and then we got another close below it. But then the price pushed all the way down and then got rejected and then reversed back up, okay? So that's why you want to wait for consecutive closes as far as I'm concerned.
Just down here, the level of which we took profits on that first trade, we have a closure. What does this tell us? Well, this tells us we can go lower. If we'd have rejected this level with a wick and pushed back up, that would be grounds to potentially trade it back the other way, right? We would be saying, okay, maybe the market is not ready to close beneath. Maybe we're seeing rejection. So therefore, we could potentially see this market return to the highs. But because we've had this closure just here, we could now anticipate that any pullbacks would provide us with pretty much selling opportunities once again. Now, for this, what I'm going to do is drop down to a 30-minute time frame, see if we have any refined areas which are unretested. We've got this supply at the top. Now, if you want to watch a video on supply and demand, click the card at the top of the video just now. I'll also put a link in the description. But at this point, we have supply zone, which could potentially be traded into. We have closures telling us this market is going lower. The reason I would use this,
not telling us the market's going lower, telling us the price is potentially going lower.
Entry is due to something called imbalance. Again, there will be a lesson in the description. And because we have the closures, we're now looking for continued downside. So if the market's able to pull back, we could look for a sell. This sell could continue down. For this trade, let's just keep it simple and look at this open demand zone below. So
shout out to
our
India,
trade would look something
in the chat.
a little bit like this. That would be the position that we could look to take. And that would provide us with opportunity to trade this market lower now that we've had closures. So let's see how this goes. If we run it through, we got closure, second closure, which is good. We have a wick here, but the market did already close beneath. So that is a good sign. It's pretty much what we want to see to confirm the downside. If we have closure, then wick, don't worry about that wick too much because the closures have already happened, right? Then we traded back to supply. We hit the supply zone. We got triggered into the position at this point here. As of right now, the trade is still going. We haven't swept this high, which is where our stop loss would.
Okay, so notice we came all the way back up here and we came up to these prior highs, which were the former resistance area. And look, every time we came up here, the bulls got rejected. Came up again, 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 bulls got rejected. Okay, so if you get 1, 2, 3, 4, rejections over and over and over and over again. That's showing you that the bears are not going to let the price go past that point. So you've got so many confirmations here once the price has done all of this, because you've got 1, 2, double top here. You've got a double top here. You've got another double top here. You've got so many double tops here. You got double tops on double tops, man. It's like a double top explosion, right? So this makes it so that now the price has basically been established that it's not going to go higher than that, but that's still not enough, right? So once you get this, once you get consecutive candles, right? So now we're looking for signs of momentum, because once we've seen that we can't get multiple consecutive closes above a certain resistance area, then we want to look for confirmation again to the downside, okay? And confirmation to the downside can come in the form of strong looking bear bars closing on or near their low. So we got one here, right? This candle closed below, 1, 2, 3, 4 candles, okay? Maybe more. And then we got another one closing below a bunch of candles. So now we have strong momentum to the downside. And then we got another bear bar closing below. And now we have 3 bear bars closing below many prior bars to the left. So here we now have the market definitely pointing bearish. So you take that, you combine that with the double tops, the many double tops here, and you have 2 data points you can combine together for a reasonable entry.
And then you can see that the market has made a big drive to the downside to fill that target, continuing the downside price action as confirmed by the candle closures we got here. We had the closures initially under this level, opening the doors to shorts. Then we had the closures underneath this level, opening the doors to continued shorts once the market pulled back. I want to bring attention, however, to this area here. Because here on the 30 minute, we can see the market did actually close, right? This level here was closed above on the
Yeah, so what about that?
30 minute. So although the hourly rejected, couldn't we get tricked into the market from here? Well, what I want to talk about is time frame relevance. Now,
Yes, and what I'm going to say about that is that you have to take the context into consideration. So if we go back to the beginning where he said, okay, this is a very simple rule. If we get a closure above that prior high, then that's going to give us a possible long. If we get a closure below it, like down here, then that's going to give us a possible short. You actually are missing one important detail, which is context. Because if you're only looking at a handful of candles like this, you're not seeing the price action to the left. And you have to consider the price action to the left as well. Now in trading, and on YouTube especially, they talk about what to do. But a lot of times people don't explain why. And the problem with that is if you don't know why you should do something, you're not going to have the confidence that you need in order to do it with the kind of conviction that you need in order to trade well. Actual trade with that technique. I'm going to take 3 of my mentors, Al Brooks, Jared Tendler, and Mark Douglas, and say why I think they would agree that waiting for the candle close is a good idea. So let's start with the technical price action rules. Again, we're talking about why. So for technical reasons, if we're talking about just the technical charts, why would it be important to wait for a candle close? Now, here's reason number 1. Avoid false breakouts, okay? We showed you that example, right? Let's go back to my chart. That was a false breakout or a failed breakout, okay? Because the price looked like it was going to break out going down here. And if you remember, we were looking at this and it was looking very bearish because look, we had 2 consecutive candle closes below the moving average. We had this one, but we avoided that false breakout or the failed breakout because we waited for more confirmation, okay? So that's reason number 1. Now, another reason, stronger signal clarity. This is what he's talking about. My man GFX is talking about this. He's saying a completed bar gives a clear view of the price action and it confirms the momentum. So that's a good reason as well. Another reason, number 3, it reduces whipsaw entries. Markets often test breakout points. Waiting for a close helps prevent premature entry. So we've been talking about that all morning. You don't want a premature entry. You need to wait for the data to confirm what you think is going to happen. Better risk management. Rule number 4, the final candle close aids in stop loss placement. Okay. That enhances your risk to reward ratio. Now, it doesn't always make it better, but it makes your probability better, which is good. And then the last one, it confirms institutional commitment. Now, this is to me the most important one, because if you're doing the opposite of what smart money's doing, if you're doing the opposite of what the billionaire whale institutions are doing, like the banks and the hedge funds, then you are, in my opinion, being very silly. Because if you're the only one that thinks the price is going down and the institutions don't, and the institutions aren't showing you some data on the chart with a strong close indicating support from those large players, then I think you're making a mistake. Now let's look at some other reasons, which are trading psychological reasons, okay? Trading psychology. And this is what I believe Jared Tendler would say. I would say he would say that it helps reduce emotional bias. I think, my opinion, my take on Jared Tendler. If I try and channel his brain here, I would say he would probably say that it reduces that emotional bias. By waiting for the candle close, you promote objective decision-making, avoiding impulsive reactions. That's a good reason. How about preventing overconfidence in early moves? Now, Jared talks a lot about overconfidence. I've learned a lot from him. And if you're not familiar, this is Jared Tendler, the author of The Mental Game of Trading. I highly recommend that book. Traders are encouraged to be patient instead of jumping in too soon. So we already talked about that. Here's some more support for that. Again, number 3, it avoids tilt from fake setups. Now that's what you could consider a failed or a false breakout. But what happens on your psychology is your psychology starts getting very unstable. And that's what we don't want when we're trading. Now, rule number 4 for trading psychology, if we're talking about waiting for the candle close, is to support a systematic approach, right? Discipline in waiting for a candle close ensures consistency in adhering to your trading plan. And the consistent traders follow their plans consistently. So that's very important, both from a technical standpoint and from a mental game trading psychology standpoint. What else? It helps manage uncertainty. Now, this to me is the best reason of these 5. The markets are filled with uncertainty, and our brains hate uncertainty, and it's one of the hardest things in trading. I mean, it's brutal, the amount of uncertainty. You think it's going to go one way, it doesn't, it goes the other way. And then it goes the way you thought after it did this thing that you weren't expecting. It's just absolutely uncertain, and there's just uncertainty at every step of the way. So when you wait for the candle close, and I really do think that this is the best reason for your trading psychology, is it helps manage that uncertainty, which is such a blessing. Accepting that traders don't control the market fosters logical coping with uncertainty. It really helps you stay calm, which is so key. Now, let's talk about what Mark Douglas might say from a trading psychology perspective. And these are my 2 mentors as far as trading psychology is concerned. One, it enhances probabilistic thinking. Mark Douglas talked a lot about probabilistic thinking. And he might say that waiting for a close encourages operations based on probabilities rather than predictions. Now, this is a very subtle difference, but there's a key distinction between probability and prediction, and you got to know the difference. Rule number 2 from Mark Douglas, I think he might say it reduces fear of missing out. You probably already know that FOMO is like kryptonite for traders. So preventing emotional reactions from fear of missing out on a move by encouraging patience. That's a very good reason for waiting for that candle close. Rule number 3, improves pattern recognition. A full bar provides better context, helping traders see the broader perspective beyond just that one little candle, right? And the video we looked at today from GFX talked a lot about that and showed you a lot of examples that we've shared with you today. The rule number 4 would be it encourages execution discipline. A structured process of waiting and confirming minimizes impulsive decision making. You need to do everything you can to minimize impulsivity. And if you don't do that, your impulses will kill your trading profits. So by helping minimize impulsivity and increasing the likelihood of you executing and discipline, that's a massive plus. And then rule number 5 here, if we're thinking, what would Mark Douglas say as far as waiting for the candle close? Well, it helps align with the market's natural flow. And that's something he talked about. You want to wait for a close because it aligns you with the confirmation on the charts of where the price seems to be moving, and it reflects the market waves rather than the randomness. Now, Al Brooks would say nothing in trading is random because trading is rational, and I agree with that. But from a practical standpoint, it would be humanly impossible to understand every single tick that happens. And if you tried to do that, you'll go insane. So you need to be able to accept that the market's just gonna kind of flow, and there's only certain things that you're going to need to know about. There's only certain things that you're going to need to know how to do. Okay, and that's good news. All right, so if you're curious about my strategy, go to tradesbybren.com/3setups and you can get my 3 favorite trades, including the patterns that I look for, how I set my stop loss to reduce my risk, and also how I know where to take profits so I can get out before it's too late. Hit the link in the description if you want to get that free download where I break it down for you in a downloadable document. And then I also have a free 15-minute training that I include with that, which shows you real examples on the chart, showing you in reality what those patterns look like. And if you're curious about the tools that I use, as I said, I use TradingView. I really do think it's the best. You can check out the link in the description for that as well. I appreciate you watching. Leave a comment, make friends in the comments. It's a lonely game. Trading is a lonely game. Make friends in the comments. Hit the like button if you liked it and subscribe if you want more. I'll see you next time.